So when will the stock market recover? When are we actually going to be able to get out of this bipolar movement of the stock market where today is up, tomorrow is down? But if you look from the all-time high, we're completely down. So when exactly will the stock market start recovering and going back to the level like we used to see before? This is an argument that I have in this video that I want to show you right here and right now. And I just ask you to give me a chance to hear me out. And then you can decide for yourself if it makes sense to you. And I'm going to talk about technicals and I'm going to show you exactly what I think. But not only technicals, I'm gonna, tell you different. Of course, it's not always gonna depend on technical, but I want to show you what historically we've seen because every single time things happen. Technical analysis, they're not just charts. They read almost everything. They basically represent the behavior of investors in the stock market historically. How we've been basically doing or how we've been behaving, the buying and the selling. And of course, yes, there is proprietary system out there. There is, but remember, they're all been programmed by somebody, so they follow what the person or at least an institution want them to do. So even if it's computerized, it still mimics our behavior, how we behave, how we have fears, and how basically we are greedy. So it's part of what's going on, and it implies everything from geopolitical issues to economical issues to whatever that could be happening in the society and how exactly the economy is doing. So without further ado, let's dive right into it. But first, don't forget to smash that like button, subscribe, and turn notification bell so you get videos just like this one every single time we post them. I'm just gonna dive right into it. All right, so here's my argument. Right now, we're gonna start with the technicals first. If you look right here, what I've got on my screen is the SPY, right? Pretty much the S&P 500. We know this is the ETF, but still, it's literally mimicking. So I want to show you what the chart, because the chart exactly is the same. And so I picked the S&P because you know why? It represents the 500 most valuable companies. Anyway, I've got some indicators here that I've put together and that I wanted to make sure you guys can see, or at least you know. So, first thing first, the one at the bottom, it is called, it's actually a combination of two indicators, the Williams percentage R and the normalized ATR, right? And so, if you look right here at the bottom, and I want you to take a closer look, you can see it's two different charts or two different indicators altogether, but I'm going to show you why they correlate with what I'm seeing. First, we are going back literally 10 years, almost 11, 10 years back. I say historically. So, first thing first, look, when back in 2011, we had another market, basically correction for quite a while because we had literally in correction territory. We had this market correction that lasted, quite some time. And during that market correction, there are things that happened. One is we went back. You see the white line right here is a 200 moving average, and the brown is a 150 moving average. If you look right here exactly, you can see that on our the candles, by the way, these are weekly candles, they did touch, both lines, or should I say they were within the 100 and 150 and the 200 moving average. They did get there. And when that happens, look what the behavior of the normalized ATR and the Williams percentage R. You can see that. I'm going to try and make it a little bit bigger so we can all see it. You can see that on the bottom one is a Williams percentage R. You can see that we went below minus 80. I need to show you guys. You can see that we went below minus 80 for quite, and we even, you can see we literally went below minus 80. which in my last video I say this is usually designed to show that the market has really sold off and we are literally close to the bottom. Again, no one is ever going to catch the real bottom, but if you can catch as close to the bottom as possible, to buy as close to the bottom as possible, which is what matters. But this one tells you really when the market is actually, or should I say, has completely sold off. All right, or should I say oversold? Now, look at the normalized ATR. The normalized ATR went above 80. See if we can change the colors here. Above 80. Right? For the normalized. All right, so you can see it right here. Now, another thing. After we saw that, if you look, the blue line that I have here as an arrow, it tells you exactly how many bars it took, or should I say how many days. It took about 302 days to go through this market correction before we actually recover. By recover, I mean from the last time the market was the all-time high and to the time after we got off the correction and the market started to making new highs. That's when you can actually call it a recovery. It took 302 days, which is close to like 10 months, pretty much. Hold on. But look, you had this much time. You had the candles going down from to basically be closer to 150 moving average and 200 moving average. You have the normalized ATR going above 80. Basically, you can see the stretch here. They're repelling each other with the Williams percentage are going below minus 80, because these are two different indicators repelling each other. And guess what? When these two indicators get closer to each other, as you can see right here, that's when the market recovered and we started making new highs. Fast forward. I want to make this quick so I don't stay on every single one of them. I just want to show you real fast. Fast forward. In 2015, market correction from all-time high, boom, to the time we recovered, 364 days, exactly a year, 12 months. Over here we said 10, over here was 12 months. And if you look, percentage R above 80, below 80. You can see that above 80 on the here and below here, and you can see the stretch far away from each other, and the market started recovering. Boom, when these two became closer to each other, right? You can see it. When they became closer to each other, the market started recovering and started going into a new trend of making new highs. Fast forward, and again, before we move on, 150 moving average brown, 250 moving average the white line. You can see that we got into this range right here. Even though the market went up and down, up and down, up and down, but we were completely oversold, we found our bottom. Fast forward, I have this one right here. That was in early 2018, right? But I will tell you what's the difference on this one. The market did not go down to the 150 moving average, wanted to say, or to the 200 moving average. It didn't. But look what happened to the normalized ATR. It did go up above 80. But look what happened to the Williams percentage R. It literally got down closer to 80, minus 80, but it never went below it. It never went below it, like we've seen here completely. It never did. It literally got closer to it. And you can see the difference I'm showing this here, right? Is like there's a possibility this could happen, but if this does not go below minus 80, both at the same time, then you could have, this was a very short correction that showed a sign of weakness in the market, which later on the same year we actually had a true correction. And by true correction, now you can see it, boom, we did go above on the average, ATR normalized, and the Williams percentage R literally went below. The true correction actually happened, and then you can see that we found bottom exactly. You can see we crossed 150 moving average, and we were able to bounce back on the 200 moving average. And how long did it take? Exactly 287 days. I know it feels weird. Again, 287 days is close to 9 months. So keep in mind, you can see 10, 12, 9. So you can already start to find the average right there. You can already start to find the average. Fast forward 2020. Here we go again. This was a literally forced market correction due to COVID. Boom. We crashed it below 150 and 200 moving average. Here we go. Normalized ATR above 80. Williams percentage R below 80. Boom. Look, the market recovered and made all-time highs exactly when these two came back and started attracting each other. When they repel each other, we are really, really in a bad shape. But once they started to attract each other again, the market started to do pretty good. And the closer they get to each other, that's exactly when we started breaking the previous all-time high. We confirm the market recovery, and then we make new highs. And this is what happened for quite a while. You can see the entire 2020 and 2021. And guess what? Right around September, we started going into trouble because they started repelling each other again. But now look what's happening. We never went above the normalized ATR just yet. But on the Williams percentage R, we went below multiple times. And you can see here 150 moving average and 200 moving average. We haven't gotten there yet. It looks like what's happened right here, but it's really showing like we're struggling, and you can see we're repelling. So I don't want to be the bear of bad news or anything like that. I'm not trying to say I'm a bear. I'm not a bear. I'm a bullish, because I always say this is the time you can buy. Anytime you see good deal, that's when you're supposed to start looking at the market and buying, right? Especially when you find everything is cheap. Almost all our favorite stocks are more than 50% off, literally right now. But I want to show you exactly when we think the market will start recovering. What do you think the market will start recovering? This is a 10-year back, literally. If you go back 10 years, do you see any sign of these two starting attracting each other again? Not yet. So what I'm trying to say is we are not out of the wood just yet. Yes, it looks like it started to pull back up, and you can see this one started to come back down, but we're not even halfway there. So I wouldn't say we're there yet. I would say we still have, and looking at what's going on right here also. But now, how long could this take? I'm not saying we're just going to keep selling off forever. You can see every time now we're selling off back to the levels that we reached. You can see we sold off here, and this is a weekly chart. We keep coming back and back and forth, right? Now, how long could this take? Well, that's what I want to show you. Let's go back to, where is my length here? We need to get this right. There we go. Forecast, date range. Boom. So now, from the top, all-time high, just like I've done to everything else. And if I were to take the average between 10 years back all the way up to now, I told you it was 10 months, and then 12 months, and then 9 months. And then in 2020, as you can see right here in 2020, it was exactly, because it was very short, but still, it was almost 7 months, to 7 months, somewhere around. So if you take the average between all of them, you realize that around 8 months, the average in the last 10 years when we have corrections, 8 to 9 months, this is how long a correction lasts. 8 months and some change, which means there's a few days in there, but let's say 8 months in total. And so now, if I take the top of this right now and give you exactly how long could this be? How long we been in? So if I were to take the exact amount of days, which is somewhere around 294 days, and I bring it all the way up to right here, boom. You can look it up and take an average, but you can see if we were to follow what happened in the last 10 years, and then we take an average on how long this correction takes between the last 10 years, 4 times it happened, as you can see, 1, 2, 3, 4, and this is the 5th time. So if we take the last 4 times and then we take an average, it gives us 294 days. And then 294 days right now, it's showing that there is a potential for the market to truly recover sometimes around October. And according to this, 294 days, it's somewhere around October 24th. Okay, I'm not saying that's the day. I can't predict the day. I'm not Nostradamus. I want to make sure it's clear to a lot of people. I cannot predict the day. I'm just trying to read the data in here. But we have to take account with a lot of different things, geopolitical issues and everything that's going on. Again, you saw what's going on in Europe, and we've just sent the government has approved to send long-range weapons to Ukraine and having them to agree not to shoot into Russian territory. That's a long shot. To me, it's yes, the Ukrainians, they have to defend themselves, their territorial integrity, they have to do what they can. And of course, they're trying to protect their own democracy and everything else because they feel, the way the war is going, and anyone should be able to protect themselves. I get it. But also, we have to look on the other side, the situation that it's very difficult to guarantee that they're not really going to use it to shoot inside. That's a very risky right there. And so it could also look like an escalation one way if you look on both ways. And it's a little bit scary. So again, we don't really like to be into all the politics and everything else. I just kind of want to show you that, hey, this situation doesn't look like it's going to end well pretty soon because we don't really know what could happen. And again, to try to correlate this to the market is things could change really fast. Before, we're not even willing to send weapons like this. Now we are. How would the Russians respond? I don't know. Frankly, I don't know. Again, politics, not our thing. But looking at the market tends to not react well when things get worse. And if we can see the crude oil is going up and up and up. Energy prices, it's astronomically crazy right now. I feel like I just want to walk every day. I don't want to drive in my car anymore. But anyway, so with that being said, if you look at this, I'm not saying that specific debt is the debt the market will recover. I'm just giving you the average that if we go historically, we could literally we're still not out of the wood, and it's going to take us a few months before we get there. And it could be something, it doesn't have to be that day specifically, but it could be in that range between, September, October, November time that we could see a true recovery. A true recovery means we actually breaks above the previous all-time high and keep going back up. That's when I would say the market truly recovered. But if you want to ask me when is the time to buy, I would say you can buy anytime because you don't have to wait to buy down here. You could buy because it's already sold off completely. It's telling us, it has told us enough to be able to say, if I buy right here, by the time the market recover and reach new highs, I will be in good shape. And when you buy good companies. So that's what I wanted to add to that. And I wanted to make sure we all know what we're looking at. At least we have an idea of where to project or where we're going. And so I wanted to keep this video short, and we're getting close to 20 minutes. And so I will stop it right here. Thank you guys for watching this video. If you like to trade in the stock market, please consider using Webull. We have a link in the description below, or Public, or any other that you like to choose from. You deposit something, some kind of monetary, we're both going to get free stock. And actually, I believe Webull can give you up to 100 stocks right now for free. So even if you just deposit $50 to $100 by opening an account. And if you would like to have a credit card, apply for a Discover credit card. We have a link in the description below. If you apply to that credit card and get approved through the link that we provide, we both going to get $50. I'm not kidding, $50. Just like that. We're getting approved to get a credit card through Discover. Thank you guys for watching this video. As for me, I will see you in my next video.